The hedge fund manager behind the Magic Formula investing strategy has delivered impressive returns from 1985 to 1994. His firm Gotham Capital delivered 50% annual returns. Late last year, he launched a family of 4 mutual funds called Formula Investing. Key here is value-weighted investing, buying stocks that look the cheapest based on yield and also return on capital. But what about the global economic weakness and European debt crisis woes? Does that Magic Formula outperform that situation?
Let's ask Joel Greenblatt, the founder and managing partner of Gotham Capital, joins us this afternoon on set for an exclusive interview. It's great to see you. Welcome.
Thank you.
Talk to me about the formula. Is it yield over some sort of return on capital? How does it work? What's magic about it?
Well, unfortunately, it's not really magic, but it does work quite well over the long term. Really, what we're trying to do is 2 things. One, buy something cheap. That was Ben Graham said, figure out what it's worth and pay a lot less. And so he looked at, what we look at is free cash flow to the price we're paying. Ben Graham's best student, Warren Buffett, added a little twist to that. He said, it's cheap is nice, but if I can buy a good business cheap, that's even better. So we look at returns on tangible capital to judge how good the company is, and we try to get the best combination of cheap and good.
What do you think about this market right here? I would think for a value investor, there appears to be a lot of value, or is it a value trap?
Well, we've looked at trailing free cash flow yields over the last 20 years. And right now, stocks are priced somewhere around the 95th percentile towards cheap, meaning it's one of the cheapest periods that we've seen based on trailing cash flows, both for the market and both for the value portfolios that we can put together. So if you really look at that, what that said, a year ahead of these kind of levels of valuation, market could be up 15 or 20%. At least that's what's happened in the past. The value portfolios could be up in the mid-30s. So, it's a very scary time to invest, and that's when you get your best bargains. And stocks are reflecting a lot of skepticism right now. And usually it doesn't look this good unless things look terrible.
Mm-hmm. Some of your top holdings, if we can go through some of these: GameStop, American Eagle, Best Buy, Microsoft, Wells Fargo, HPQ. Is there a narrative that runs through them other than the formula itself?
The narrative is that each one of those companies is hated brutally by most people. Hewlett-Packard, I think we know the story. Then again, it earns close to $5 and is trading a little over 4 times earnings. So you pays your money and you takes your chances. But in this particular case, if you look at all the analyst estimates, they're expected to earn $5 for the next 2 or 3 years, each one of those years. So you're going to get your money back in the next 4 or 5 years and own the company for free. At these kind of prices. Wells Fargo, we sort of know the story, but the prices are very cheap. That's one that Warren Buffett likes.
How do you differentiate the financials? Several years ago, everybody was asking the financials, wow, they're so cheap, but are they a value trap? Will they get cheaper? You've managed Wells Fargo. How do you differentiate amongst that particular sector?
That happens to be a great question. I first put together the Magic Formula. I wrote the book came out in 2005. Because of the metrics we used, we actually excluded financials. There was no projection that we were going to have a financial crisis. It's just that one of the metrics we were using was earnings before interest and tax. You can't look at a bank before you're looking at an interest. So we've actually since then developed metrics that work quite well for banks as well as other companies. And so we now include banks in our widely diversified portfolios. And Wells Fargo comes up very cheap right now.
What do you say to those who say historical patterns are meaningless if the global economy is really at some strange inflection point where we're about to go through a looking glass, if you assess the situation in Europe?
Well, every time we've had valuations this low, the macro environment has looked terrible. And so at a minimum, you would say that prices reflect that people are skeptical. Prices reflect that things might not be so great next year. And every one of those periods where we've had these low values, the macro environment has looked bad. If this is unprecedented, I can't really answer, except a lot of bad news is already in those prices.
It's one thing to know that in your head and to hear all of those numbers said. It's another thing to have the guts and the heart to buy when everybody's so terrified. Is there some psychology here that lets you do that? I mean,
sure. Actually, the magic formula approach, we put together mutual funds that are similar to that strategy, and it's really numbers-based, meaning it takes out the emotions. So the computer is not very emotional. We actually now do the work ourselves. We look at the balance sheet, income statements, cash flow statements of the companies ourselves, so we know the data is good, but we're still not projecting the future. We're just making sure that the numbers we have for the present are good, and they've worked quite well over the last 20 years. All I know how to do, what I call value investing, is figure out what it's worth, pay a lot less. That's all you can do.
So simple and yet so hard to do sometimes for some people.
It doesn't always work.
Right.
And that's, if I wrote a book that had a formula that worked every day and every month and every year, everyone would follow it and stop working. The great thing about this is it doesn't always work. Over the long term, this is how the market prices stocks.
Okay.
But in the short term, it gets emotional. And it gets emotional for sometimes good reason. But a lot of that, I believe, is reflected, and I think there are great opportunities out there.
Well, if you come up with a formula that works 100% of the time,
I won't tell you.
Please come back.
With the exclusive. Thanks, Joel. Good to see you.